Okay, we're gonna get started soon. The chat box will run up to 900. 900 hella soon. Okay, cool. Hold on. Let me just quickly see the messages. Okay, guys. Wow, if you guys don't know who I am, I'm Jazz Lau, Platinum 2000, in Traders Empire. Wow, been trading for the past 2 years, right? Been trading for the past 2 years. Traded retail completely for the first year. Traded retail completely for the first year. Didn't make much progress. Still made a bit of money, but I didn't really make as much progress until a good friend of mine, actually said to me, he's like, look, there's this institutional thing, right? He started showing us, 1 to 7s, right? And I ain't ever seen I ain't ever seen a risk to reward more than 1 to 5. And I was sitting there thinking, I was like, damn, so this guy, like, wow, 1 to 7, that's amazing. Obviously it took us a while to master it. And for us, I would even say, he's a way better master than me. I'm gonna chat about the two individuals separately. But the one thing that you guys need to understand is that every single master was once a disaster, right? You guys might see the bank now, catching all of these pips, all of these risk to rewards, right? But I promise you at one point they were also, maybe in your position when they were first putting, the numbers into MetaTrader 4. Okay, the numbers into the MetaTrader 4, right? And see, the good thing is, right, let me tell you why, their journey from being, a disaster to being a master, was, let's say, longer than yours is going to be, because when you have mentorship, right, my mentor, Daniel Gbola, if you guys know who Daniel Gbola is, it's crazy, right? You guys know what's about to happen. He said to me, he was like, look, mentorship is just a shortcut to success. Okay, the shortcut to success. Let's run this up to 1,000, man. Let's run this up to 1,000, We need 60-ish more. Right, go back to the chats. Go crazy in the chats. Go crazy in the chats. Tell them the bank are coming. The bank are coming. They're gonna tell you have to rob the bank, right? So, these two individuals, when I first got started in the business, the first individual was the first one who I showed the business to. First individual was the first person I showed the business to, right? And the reason why I showed it to him, he was actually, he's my best friend, right? Probably he's my best friend in the entire world, right? And the funny thing is, this individual, not only was he sitting his A-levels at the time, he didn't see a presentation, he didn't see the academy, he didn't see the comp plan, he saw nothing other than the reviews online, right? Other than the reviews online, and most people, they'd be like, nah, not for me. Right? And he turned around and said to me, he was like, Jazz, is this what you want to do? Is this it? Like, are we doing this? Is this going to make us money? I said to him, I was like, listen, I'm doing this, right? And he said to me, he's like, okay, came on with me, right? Didn't do anything for his first month. Obviously we're sitting his A-levels. And over a period of time, he went to university, right? Alongside completing a chemistry degree, which he's currently doing, right at this moment. Alongside doing a chemistry degree, he decided, he was like, look, I'm going to pick up the skill set of trading. And not only did he decide to pick up the skill set of trading, right, he also decided to help, other individuals, with trading, hit Platinum 600 in the process, right? About to hit Platinum 1000 very soon, right? He helped other individuals. And then he also decided, I want to take this to the next level. So what he did, he actually, started watching Go Live. He started watching, Trade House and Go Live. Let me just quickly check how many people we got. We got 965, 35 more. He started watching Go Live. He started plugging in, okay? And he started asking the right questions. Most people, they don't ask the right questions. He started asking the right questions to get knowledge. And, this individual then went and caught, 1 to 50 trade, right? Started off with 1 to 10, went to 1 to 10, went to 1 to 20, 1 to 30, 1 to 40, 1 to 50, right? He even marked up 300% growth in a day, right? Euro USD. 300% growth in a day, right? Some people, they struggle to make that in the whole year. Some people, they struggle to make that in the whole year. He did it in a day. Okay, so I'm telling you now, I'm telling you now, you're listening to the right person, right? Because that's step one. Who you listening to? You're gonna listen to the right person, okay? But second individual, man, the second individual, I went to school with him for 6 years, but I never spoke to him. The only thing that I know of this guy was I was like, yeah, this individual, the only memory I had was he was on the playground and he used to have like a pot of fruit, and that was the only memory I had of him, right? Like he just used to stand on the playground eating fruit. And I was like, okay, cool, right? But I never actually spoke to the individual in school. I never got to know him, right? But he was damn good at school. He was so good at school. Like, let me just quickly check. Have we max? Oh, we're about to max out. Come on. Let's run this up, man. Let's run this up. Go tell your friends. Tell your grandmas. Tell your mom. Tell your parents. Tell everyone, right? Your brothers, your sisters, girlfriends, boyfriends, everyone, right? They get him onto school. But anyways, this guy, he was very good at school, right? He was very good at school, but this was the thing, right? I never really got to know him, okay? And although I actually had the opportunity to present the business to him, I didn't. I didn't. Like, and that's on me, okay? That's on me. But regardless, he came in, right? He spent, I think, about 7 months on demo. He never came to an event. His first event was on my birthday, actually, which was April 15th, okay? So write that down for next year. But his first event was on my birthday, and he only came through to do a training. He started doing the training, and we were looking and we were like, okay, cool. Like, this guy, we ain't really seen much about him. We ain't really seen much about him. He hasn't really traded. We haven't really seen him trading, right? Well, one more from maxing out. But we haven't really seen much of his trading, right? But he came in and he bodied the training. Let's drop some fire in the chat for the fact that we maxed out. But yeah, he bodied the training, right? And then over a period of, I would say, about 6 months, he grew his trading account. He started compounding his trading account, right? But not only that, he started learning institutional concepts. He used to say to Kyle, he's like, you don't need institutional, right? He's like, you don't need it. Like, he's like, it's not necessary. And then, regardless, he came in and he learned, right? He learned so much, right? That the two of these put together, they've educated over 500 people worldwide, right? They've educated my whole team, okay? TEC, right? We've got over 1,000 members in TEC. They've educated the whole TEC. These individuals put together, right, are a force to be reckoned with. I'm just gonna say it straight. They're a force to be reckoned with, right? These two individuals, I'm very lucky to have both these individuals in my life, because I don't judge people, but you can tell a lot about people, right? You can tell a lot about a person when they do something for someone else, right, without expecting anything in return. Because when they were helping me, there was nothing that I could give them, right? And I know they've helped countless other individuals, right? They've crossed oceans for people that wouldn't cross puddles for, okay? But with these two individuals, I'm going to let them take it away. I'm going to pass it over to the bank. I'm going to quickly unmute them. Okay, let's unmute. There we go. Yo, the bank, can you guys hear me?
Bro, I can hear you, bro.
You can hear me? You're a little bit quiet from my side. Kyle, you there?
Yeah. Could you?
Amazing, cool. I'm gonna hand the host back to Mohammed. But yo, let's do our thing. Everyone, get your notepads out.
Mohammed, can you pass screen share over to me, please? If he's there.
Yep, you're good to go now.
Cheers. Okay, cool. Let me just bring up the chat as well. Actually, no, it's gonna blow up my thing. All right then. Let me just move this. All right, cool. Amazing. Oh my God, 1,000 people on the call. That is absolutely insane. But pretty much, yeah, I can't lie as well. I appreciate every single good word that Jazz has to say. I love that guy, man. So yeah, pretty much, right. Day 2, starting off the boot camp, right? So it's kind of organized into two halves. I'm going to go over more of the presentation side and the concepts that we're going over today. And then I'm going to directly pass it to Makan, and he is going to absolutely kill the charts, right? So with that all being said, I'm going to jump straight in as well, right? Our Instagrams are there. So if you guys have any questions, if you want any more extended material on what I'm going over, pretty much just DM us, either of us, and we'll be happy to help, right? So the first thing I want to go over is price and time, okay? I'll be honest with you, price and time is an absolute deadly combo. All right, cool. So this is kind of something that I didn't actually learn until quite far into my journey, right? And timing can be something that is pretty much pivotal in training, right? In trading. So there's actually a kind of like a strategy or even a culture within the bank. It's called like the 8 a.m. move. And we were holding quite a lot of Zooms in the morning where we catch this 8 a.m. move. And I'm basically going to kind of go over the basics of that, okay? So before I go on to that, I want to talk about best sessions to trade in. Now, I guess everyone knows about, there's London session and there's New York session and Asian session, right? You learn that in the academy, okay? But I kind of want to take that to a further degree, okay? So first of all, you have London as a whole, okay? London Open is 8 a.m., okay? But for me, these are the kind of the best session times to trade. So within London, between 7 and 10. The reason why it's such a big gap is because a lot can happen in London, right? You can kind of get some really nice moves. I'm going to go over that later as well, but you can get some really nice moves, right? On the other hand, you have a New York session, which is 1 to 3. Okay, absolutely beautiful time. New York brings in a lot of beautiful moves, right? And this is another thing, I wrote here, New York Stock Exchange Open. Now, this is something that a lot of people don't talk about, right? But this is kind of for people who trade indices, okay? So if you trade stuff like US 30, UK 100, okay? You have something called New York Stock Exchange Open, which is at 2:30 BST, 1:30 GMT. Okay, that does change with our clock difference time, right? Because before that used to be 1:30. So that's 2:30 currently, okay? And I'm going to also explain what the significance of this is, okay? So I mentioned to you there was 3 sessions, London, New York Stock Exchange, and New York, okay? So what to expect when a session opens. Now, when a session opens, you usually get an influx of volume. What that basically means is price is going to move in a quick position to a specific point, okay? And to put it in a very basic terms, these are the 3 things that you want to look for, okay? So you either want to look for a capture of liquidity. So yesterday you were learning a lot about liquidity and FU candles, right? You want to see a capture of liquidity, okay? You either want to see, and you can see all of these as well, right? These are just the kind of 3 things that you want to see, right? Capture of liquidity, mitigation of institutional candle, and fill of imbalance, IPA, right? Same thing, imbalance, IPA, inefficient price action, all the same stuff, right? I do want to open up the chat box quick, right? Just see if I've got questions, but oh no, it's going to freeze it up on Q&A. Okay, I'm going to leave it, right? So pretty much, right, you have these 3 things that are going to happen. Followed by that, you're going to have an impulsive move. Okay, so going back to these kind of time frames and these sections that I was talking about where these are the best times to trade, right? During London, for example, here, you're going to get a big move at 8. Okay, not on most days, I'm not going to lie, at 8, you're going to get some sort of influx in volume that's going to push price somewhere. Okay, New York session, it happens around 1, right? When I say around, probably look, this is what I do personally, right? I look at about half an hour to an hour before a session opens, not for New York Stock Exchange, just for New York session and London session. I look for about half an hour before the session opens to see some sort of liquidity build up, and then I'm expecting some sort of move to take out liquidity and then reverse, okay? So I'm going to show you some examples, right? So pretty much you have, I don't know the chart, right? I don't know what the pair is, but here you can see, okay? So this purple box here is the zone between 8 to 8:30, okay? So pre-London, which means just before London session open, you could see that price was moving very nicely and it left this imbalance area here, okay? This imbalance from here to here. Again, I'm not going to dive too much into entries and stop losses because that's for another day. That's, I'm pretty sure, being covered tomorrow. But I'm just trying to go over the idea of price and time right here, okay? So pretty much you have this area of imbalance, okay? There was liquidity left here. At 8 a.m., right, you have that, it was up here, that 8 a.m. pushed all the way down, probably completed that within about, looks like about 10 minutes, right? Lovely push into that fill of imbalance, which is one of the 3 things that we look for, right? This is on the 1-minute chart, so this is an imbalance fill, and then price shoots nicely up. If I extend it out, we'll hit TP, right? Targeting these equal highs above here, because again, as mentioned yesterday, equal highs are targets, okay? Another example, okay? This one is London Open again, right? So this is between 8 to 8:30. You can see here, right? You have this liquidity. So this is exactly what Issam was talking about yesterday. You have this liquidity made, okay? Then you have this nice institutional kind of come up, push, take out liquidity. Then you have this nice runaway. And then look, see what happens at 8 a.m. exactly. What, to be fair, at 8 a.m. exactly, liquidity got taken. Exactly what I was talking about, right? So at 8 a.m. exactly, liquidity got taken. Price ran down. Price then came back to retest that candle, much like spoken about yesterday, where you place the entry at the open and the close of the candle. Here it says M3IC, which means 3-minute chart institutional candle. So that's the entry, that's the stop loss. TP's down here, probably obviously gone off something else, and that's a very quick TP hit within, what's that, about an hour and a half, right? Nice and easy. This is another example, okay? So you can see that pre-London liquidity was being made, okay? You have this last up candle before this down move and this imbalance. Prices come up precisely at 8 a.m. to take that liquidity out and fill this 1-minute order block, right? And then drop, okay? So that's kind of price and time in a very, I guess, simplified way, okay? The other thing I'm going to touch on is something called Wyckoff theory, right? Wyckoff's quite a big buzzword at the moment, and I'll be honest with you, I'm not gonna lie, it's a very useful tool to use within your arsenal. And if you'd like something, that kind of material that I haven't really included here, then I can give that to you, right? But this is kind of Wyckoff from a basic level, and I'm going to include a little bit of advanced stuff, but again, that's going to be covered later as well. So with Wyckoff logic, right, there's 4 stages. You have the accumulation, you have the markup, you have the distribution, and the markdown, okay? Understand that you've already seen this type of pattern before, okay? From day one, you've learned that. So these blue lines are pretty much double tops and double bottoms, area of liquidity, okay? This spring, okay, is where that liquidity has been taken out and then prices reverse. So after every accumulation or distribution, you get a big move, okay? And all accumulation and distribution they're kind of fancy words for something else. And all they really are, okay? By the way, there is some noise. Mohammed, if you can mute whoever, I can't do it, right? So yeah, understand that accumulation, distribution, they're types of distribution, they're types of consolidation, right? A lot of times you're told, okay, don't trade consolidation, stay out of consolidation, only trade trending markets, right? But from a consolidation always leaves a big move, right? And if you understand what that consolidation is telling you, then you can move from that, okay? So pretty much I'm going to kind of break down what the accumulation is right here. So all you have is you have money resting above these 2 blue lines, okay? Pretty much, right? This is kind of like a retail trap, right? Also mentioned day one. The reason this is a retail trap, okay, is because at this blue line, a lot of people are going to have their entries, okay? A lot of support and resistance traders are going to have buy limits, okay? Just for example, in this line, here is their buy limit, okay? A couple pips below, let's say a common retail perspective is like, okay, cool, put your stop loss 30 pips below the resistance line or however many pips you use, right? Understand that below this line is going to have so many accumulated stop losses, so many, okay? So that's one type of stop loss that's going to be there, okay? The other side, right, there's going to be another type of order, and that's something called a sell stop, right? So during this line, right, this is something called a breakout trader. Well, a breakout trader expects resistance to be broken, and basically what they expect is, right, and Issam done a very good job of covering this yesterday, but pretty much, right, as soon as that line is breached, so as soon as price comes below this resistance or support, right, they expect prices to just fly in that direction. So what happens is loads of people put sell stops here, okay? And then what they're expecting is the price, as soon as price runs through, they're expecting price to just die, okay? But you can see, right, these people are getting trapped as well. These people who put sell stops here, price is coming down, putting them in profit for a couple seconds, right? Because the spring is always very quick, okay? A key tip there, spring is quick, okay? Quick injection of volume. So you see it will run in and then it will just yank them to the top. So all of those people, whoever put sell stops, whoever put buy limits, are going to hit stop loss. Okay, and that's kind of the retail trap, right? And in essence, that is just really an FU candle, okay, in very basic terms, okay? So you're going to see this FU candle form, price is going to run away, then price is going to come back to retest that FU candle, and then price is going to fly, okay? It's going to do the markup, and that's the move you want to catch, okay? You want to catch it along here, you want to catch it at this point, and then you want to see price right up, okay? It's the same with the distribution, okay? Again, I've got some chart examples for this, so don't worry about it. So you're going to have this top line, bottom line, and it's the same logic, but in reverse, right? All the retail traders are taken out of the market, and then price is going to reverse, right? Any of you guys who trade retail, you will know exactly what I'm talking about when I say, okay, that let's say you had the direction bias correct. Let's say you knew exactly where the market was going to go, and then your stop loss gets hit out by a pip and the market reverses in your direction. It happens every single, like it used to happen to me so much, and I couldn't understand why. And this is literally the logic why, right? So that's Wyckoff from a very basic perspective. When you get a bit more advanced, it has a lot of labeling to it, okay? And the labeling, right, I'll be honest with you, it's not necessary in a picture perfect sense, but to understand what each individual point means, right? Makan's going to go over a bit over it, but to understand what the selling climax is and how to identify the AR is quite important, right? It is quite important. But from a basic standpoint, right, I've drawn out these 4 pictures. So if you want to take a screenshot of this, this is what Wyckoff looks like if you're just looking at it from a very basic point of view, okay? So I'll give you, I don't know, like 5 seconds to, or I'll talk over it, right? Give it a screenshot, okay? So understand that these are the kind of 4 patterns that Wyckoff is going to present itself in from a very basic standpoint, okay? When you get onto more the advanced stuff of trying to label up the letters and stuff, okay, it isn't going to naturally look like these. But when I started learning Wyckoff, if we're like right out of the bat, I looked for these 4 patterns. They're very useful, okay? So again, if you want to take a screenshot, do so. That's good. Okay, cool. Now, again, I'm going to touch on a little bit of advanced Wyckoff stuff. So I'm not going to do too much because it's being mentioned on Friday, but this is more for the advanced people who kind of know what Wyckoff is already, right? You have movements called reaccumulation and redistribution. Now, these are fancy words for, imagine half a distribution, and this is probably the most simplest way I can say it, right? Imagine half a distribution, imagine half accumulation, stick it together. Okay, understand this kind of looks like a 3 drives pushing up like a BC, UT, UTAD, and then understand that liquidity is made, and then you have that spring from the accumulation, and then price jumps up. Okay, again, I'm going to show you some more examples of it on the chart. It's all good, but understand it's kind of like amalgamation between 2. Okay, reaccumulation and redistribution is just this, but the opposite way around. So you have an accumulation and then stuck basically with a distribution on it, okay? And understand for you Wyckoff traders who know a bit more about Wyckoff, right? When you start entering phase C, that's when you'll be able to distinguish between whether it's going to be an accumulation or a redistribution, okay? Again, if you don't understand what I'm talking about, it's cool. I wanted to add some stuff for the more advanced people who obviously have come here to excel their knowledge. So understand that here, when you start getting to phase C, right? If it's going to turn into something like a redistribution, you're going to start seeing a U-turn, right? You're going to start seeing a liquidity spike. If you, for example, if it starts off with a distribution and you think it's going to start to turn into like a reaccumulation, for example, you're going to start to see a spring around phase C area, okay? A big thing as well is that you need to understand, for you guys who are looking more at advancing Wyckoff, a lot of people come to me and they go, okay, cool, well, I see 3 drives all the time and it looks like it's going to reverse and understand, right? First of all, and this is something Makan told me, even like we were talking about it recently, right? And this is a big lesson that I learned from him, right? Is trade continuation. Don't look for reversal, just trade continuation, right? He's going to go over a bit about it, but just understand if price is moving up, follow price, right? If it's got so much momentum to the upside, don't expect it to fall, right? And that's the best thing about reaccumulation, redistribution, is because normally you get an accumulation, right? And that just pushes price up. But midway through the trend, you're going to see some sort of reaccumulation that's going to push price up even further, okay? And it's vice versa. You're going to have a distribution, then you're going to have some sort of redistribution in the middle, which is going to push price down more, okay? So yeah, here are some examples of reaccumulation, redistribution, right? I think kind of the key, not the key thing, right? A big thing that you kind of have within reaccumulation, redistribution, not always, but you do sometimes have this kind of creep, right? It's not like a dead giveaway or anything. More or less what you want to look for, right, is positioning in the market. Understand, if you start seeing this distribution pattern in a random position and a point that isn't of a point of interest on a higher time frame, why are you going to expect it to fall? Right, you need to look for why. A lot of people struggle to look for Wyckoff because they're not looking at it in the correct places. You need to find Wyckoff. For example, if you're expecting price to reverse on a higher time frame, right, then cool, yeah. If it starts from a distribution, be confident in your distribution. But if price is just forming a apparent distribution in a point of nothingness, then don't expect price to reverse. Look for a reaccumulation, look for a redistribution, look for trend continuations, okay? So here you have this kind of looking like a distribution, right? Then you have this nice creep, right? A big thing I learned trading reaccumulation, redistribution, right, is that I think 2 dead giveaways, right? One, if price does not run away from your apparent distribution, it's not a proper distribution. Okay, if it's just moving away like this, that's not a proper distribution. If this is your apparent test and price is just sluggish, right, moving away like this, there's no way that's a valid distribution, right? But even the best thing about this is that you can see it's started to make so much liquidity, really nice for the spring to come and take it out, right? Nice little breaking structure, come back for the test, play this fill of imbalance, rides up. All right. Another example, you have this kind of free distributionary phase. Okay. Then this decline, which again goes into this creep kind of thing. And then you see, look, price is just fumbling around. This isn't, if this was a real distribution, price would just melt. Understand that, right? So understand that price came back up, price gives quite a nice spike down, and then price absolutely just erupts to the upside. These ones are quite clean, I can't lie. If you get this really nice eruption to the upside, you know that as soon as it comes back to this candle, it's game over, right? We're just playing this last down candle for the up move. Very, very simple, very, very nice. Okay. This one kind of got 2 schematics in there. This is a distribution. Again, not the cleanest distribution, but again, what Makan's going to go over is more about how to identify why something may be a distribution from a non-basic standpoint. All right, so here you get your nice BC UT liquidity made, UTAD take it out, rush to the downside, breaking structure, test, and then price seems to melt away, right? Very nice melt. Last point of supply, then price literally melts, right? Then you have this SC, and this doesn't even really give an accumulation like structure, but this gives a really nice creek and a really nice UTAD. So for this, you wouldn't really be confused thinking, oh, is this accumulation? Because it doesn't even look very closely aligned to accumulation. So this would have been really, really nice move. You have this nice injection of volume, run down, test, cut, right? So and the next topic I'm going to go over is fractals. Okay, now fractals, pretty much understand that market fractals, the meaning behind what it is, right, is understand that if you find an institutional candle on a 1 hour, for example, or you find liquidity on a 1 hour, okay, and you find this really nice setup with imbalance and all that, right, understand that setup that you found on the 1 hour, okay, can look identical on the 1 minute. I'm not saying they're in the same area, but all I'm saying is that this, so for example, that setup that you found on the 1 hour, you can find that exact same structure, that exact same candle, that exact same pattern on any time frame. And that's what the meaning of fractal is. Okay, if you can see it on every single time frame, it is abundant within the market. That's why a lot of people say, like, don't get scared if you miss a move, because there's so much going on. Even if you have access to something called the 5-second time frame, the stuff that we're trading on higher time frames is viewable, and you can find it within the 5-second time frame. Okay, so that's an example of what I'm talking about within fractals. The way I'm kind of using fractals in the sense of Wyckoff within Wyckoff here. Okay, so understand that you're going to get accumulations within accumulation. So this is actually a reaccumulation. Again, this is more the advanced stuff. So if this is kind of boggling you, then it's all good, right? Don't worry about it. This is kind of a reaccumulation. So this is an accumulation within a reaccumulation. So understand that this is a reaccumulation schematic. You have this nice kind of looking distribution area. Then you had kind of price wobbling a bit. Then you had this nice little creep. Again, showing you, look, price did not run away. It's giving that kind of sluggish, sloppy price action, right? Leaving liquidity, nice little run, nice little, like I said before, quick spring. Spring is quick, nice injection of volume. Then you have this nice uproar of price, right? It really gives a nice move up, okay? Price comes back down. You have this last down candle for the up move that's been highlighted here. And price makes this little small time frame accumulation right within the test area, okay? Test being the best place to get in, okay? So understand that this gives a little nice liquidity made here, spring, move up, comes back into the last down candle, and then price erupts, right? Little accumulation within a reaccumulation, okay? This is another example. Overall, this is a reaccumulation, right? But I can't like this. You know what? Yeah, this is one of Makan's shots because it's absolutely marked beautifully. Like, I can't do this, right? But his markups are insane, right? So understand, right? This is the distributionary phase. Okay, so you have this kind of 1, 2, 3, looking like a distribution. Yeah, all good, right? Then price seems to fall off, the decline. Okay, but do you understand that if the distribution is this big and the output of the distribution is that small, and then price starts consolidating again, this isn't going to hold. Like this isn't that strong of a distribution, or in actual fact, it's not distribution really. It's going to turn into something else, right? Nicely, he's incorporated volume as well. I'm not really going to talk too much on that. If you want a bit of information on that, you can DM us, right? Understand that the spring, there's a beautiful level of imbalance here, right? It's tapped in perfectly, right? Given a lovely spring, given a nice little break to the upside, come down, little test area, come up, and then within that, okay, you have this minor reaccumulation. Again, this little distribution here, accumulation stuck together, this accumulation looking kind of area. Spring moves up, comes back, tests, runs up. Okay, so understand, yeah, you have pretty much you have patterns within patterns within patterns within patterns. Okay, this is another one, a distribution within a distribution. Okay, so pretty much you have this, well, yeah, this is pretty much quite simple, I can't lie. You just have this distributionary looking kind of area on a bigger time frame, but within that, when it really gets to this point, the higher time point of interest, you have an even smaller distribution created within. Okay, and this is kind of a combination of ideas. This bit's quite short because this is the bit I really want Makan to touch on. He's going to do like an amazing job of it, right? So here is me combining stuff like timing with Wyckoff. Yeah, that's pretty much what this bit includes. So this is, I said here, missed, right? So this is something that I didn't catch, but something that was good to put in my documentation. Because the thing is, right, it's another nugget as well, document everything you do. This is, again, something Makan taught me. Document everything that you do, every trade you take, every back test that you mark up. Put it in a chart, put it in a, like literally make a catalog of your trades. That's the best way to explain it, right? So again, you have this kind of accumulation looking area, the spring, and then price comes down, and it doesn't fly, like it doesn't, you don't see this nice move away, right? You obviously would want to see some sort of test, but we don't even get that, right? We just see price kind of fall off, okay, and then price comes up, price takes out liquidity, and you see at pre-London it's just taken the liquidity, and at 7:55 it comes back into that imbalance, and then it flies up, right? And this whole thing as a picture is a reaccumulation. Okay, another one here, this one's really cool. So to the left I had a point of interest, right? I drew the line out here with liquidity was made. So at pre-London at 7:47, okay, instead of 8, because sometimes liquidity is taken maybe 13, 14, but I say anywhere between 30 minutes before 8 a.m. you can sometimes get a liquidity spike, right? So you've got this little liquidity spike, very nice accumulation looking kind of structure here. Price comes up, price comes back down. Right, this is on the 1 minute chart, so you'd need the seconds time frame to find the entry here, right? Price moves up, kind of like a breaker play here. Again, I'm not going into entries, but a very nice breaker play here, right? And then, like I said, once you get that kind of fulfillment, you're getting a lovely move. And like I said, right, when going back to the first slide I spoke about, after you get the fill of imbalance or the institutional kind of play or the I think the fill of imbalance, right? After all of that, you'll get an impulse, right? And especially during London as well, you're going to get an impulse anyway. You're going to get an impulse after an accumulation anyway. So all of this is a very high confluence trade, right? That's pretty much everything I wanted to go over. I'm going to pass it on to Makan to absolutely slay the charts, right? You are muted, yeah?
Oh yeah, I'm unmuted. I don't think it'll make me host or something, so I can pat on the screen share or something like that.
Yeah.
She might even let me.
You're able to screen share anyways.
Oh, okay, Makan, you can screen
Okay, 6. Yeah, I don't actually need to share my screen right away. But yeah, first of all, I just want to say, obviously very grateful that me and Kyle have been allowed to hop on this call. It's kind of crazy. I remember when I first started, but our strategy was like just draw like a trend line and then do a measured move and draw a Fibonacci. That was our strategy, and that was obviously it wasn't really a strategy kind of thing, but that was a one-on-one Zoom that we would have, you know, all this time ago. And now we're doing a Zoom with 1,000 people, just kind of crazy. But, you know, I'll talk about what I kind of want to talk about in terms of what Kyle's gone over. He's gone over, like, you know, Wyckoff, fractals, price and time. That's pretty much all, you know, that's the thing that has taken our trading to another level. When we understand these concepts, that really helps us kind of thing. But I know that when I first learned Wyckoff and even price and time, like a lot of you probably, I didn't really understand everything. I didn't really understand everything that clearly, and I never really understood all the annotations about Wyckoff. I saw like it started looking like some mad alphabet thing going on. I never really understood. Let me just like pin my video or something. Yeah, I never really understood, you know, all the annotations, and I kind of blocked it out because it was kind of confusing. So I was just like, okay, cool. I don't have to learn that. I'd rather just keep it simple and just play my normal liquidity, you know, entering off higher time frames, not really understand lower time frames. But when you understand that everything kind of fits together, and time is just continuous, and the same way that price is, there's no like separations, you know, everything runs smoothly. So any big movement in price, any accumulation, you know, in a higher time frame is going to happen on the lower time frames. But I kind of want to talk a little bit about Wyckoff, and just to help people understand it. You know, Wyckoff isn't something that, it's not a strategy. It's not a strategy. You can't say, yeah, I use Wyckoff strategy. That would be like saying, oh, I use Fibonacci strategy. I use Elliott wave strategy. That's not really what it is. You know, Wyckoff's a way of looking at the chart. It's a way of thinking, and you know, Elliott wave and Fibonacci, they're tools. A little bit like how Wyckoff is a tool. It's a way you can note something on the chart based on, you know, a Wyckoff way of thinking. I got a couple notes. You know, I didn't really plan like a presentation or you know, concrete example to show you. I have got some examples which I'll talk to you guys through, but I've just got some main points that I want to talk about. You know, understand that, like I said, Wyckoff isn't a strategy, but, you know, and it's got nothing to do with institutional trading. You know, this you know, these words get thrown around, all this kind of thing. You know, what Wyckoff can be applied, this kind of logic can be applied to any kind of trading. You know, someone that uses trend lines, you know, retail traders, they can still use Wyckoff. There's pure Wyckoffian traders that don't even know what an order block is, that they don't even know what institutional candle is. They don't really understand, but they've just got the logic down so well. They've got the understanding of, you know, what this Wyckoff logic is. And the idea behind it is that, you know, smart money, you know, before they you know, move the market up, before they get in a move up, they want to make sure that no one else is in the move. They're shaking out, you know, all the buyers and sellers, you know, either side. They're getting rid of those people so that they can run up the market themselves, and that basically means that the move is going to be low resistance. So understand that any move you get in the market, it doesn't just, you know, the market was born one day and then boom, it just spiked. You know, every single move has to start in a consolidation. Every single move, you know, every uptrend either comes from, you know, a previous area of consolidation. But this is where it really helps to understand logic. I might just share my screen and bring up TradingView real quick, because I'll be able to like break down a few things. Okay, so I've got on here the 3 Wyckoff laws, but I won't go over them right now. The first thing I want you guys to understand is that everything starts from consolidation. So say, for example, you got a phase of consolidation and then price moves up, that'll be your markup. Then you could have another area of consolidation. Every single move has to start from something. It doesn't just, you know, come out of nowhere. But yeah, like what Kyle broke down is the 4, you know, schematics that we have. We have accumulation, distribution, reaccumulation, and redistribution. Understand that what he pointed out in trading is that, you know, why would you trade, you know, reversal every single time? This is one thing that I'll touch on a bit later on, which once people, as in, you need to realize things yourself for you to learn. Otherwise, you're going to keep making you keep doing the same things and you'll get the same result. If you realize something that you've done wrong, you'll then, you know, effectively change it. But when it comes to these kind of patterns, when you hear redistribution or reaccumulation, that's a continuation pattern, because what that means is, you know, all this consolidation phase is transferring, you know, from A to B. We're going from A to B. We're either going from sellers to buyers, or we're going from buyers to sellers, or we're going from sellers, then we're shaking everyone out and we're going back to the sellers again. Or we're going from buyers, so we might have accumulated price, we might have moved up. Now we're, you know, rather than having a reversal pattern, we could have that shakeout, you know, get rid of everyone else, get rid of all the weak people in the market, and then continue price up. So I'll put some notes on just in case you guys want to take notes. But just to reiterate, we've got continuation, and this is going to be your reaccumulation and your redistribution. Then we've got reversal, which is going to be your accumulation and your distribution. So just think about this logically, because I'm not really the most, when I learn something straight away, you know, I'm never going to get all the order block mitigation. It's never going to click right away. But if I can understand it, it will help me a lot more figure it out. So think about this logically, right? If you kept on trading reversals, then this would mean that the market would do this. This would mean the market would come up and it would reverse. Then it would reverse, then it would reverse, then it would reverse. If every single schematic that you saw, every single period of consolidation was a reversal, then this is what's going to happen. It's just going to, you know, it's not going to have any trending structure. It's not even going to make sense. The market won't even make sense. So that is why you need to understand that continuation is more common. Otherwise, you won't even have a trend. You know, this is the reason why these kind of things click together. The other thing that is important to understand is, which is something that I really like to promote when it comes to trading, is that people are always trying to find this thing that works every single time. Oh my God, if I see this, this free drive pattern and a break of structure, it has to move the market. That's the golden rule. I've hacked trading. They get this idea that that's what it is. From my opinion, you're never going to find the golden rule. If you do, you're going to be a billionaire overnight. But the idea is that you're not going to, if you learn Wyckoff theory, if you learn the logic behind it, that doesn't mean you're going to be able to catch every single move just because you understand what a schematic is. But Wyckoff logic is behind every move. It's behind every single move because smart money is operating in all markets at all times, and they've got an objective. Everything they do. So understand that this is this bootcamp as a whole. Actually looking at this bootcamp as a whole is not something. It's not something to give you some sort of sheet where you write down every single day you're going to follow this thing and it's gonna give you 1 to 10 every single day. The idea is that it's going to just give you more tools to equip your arsenal when it comes to your trading methodology. And if you understand things, you're going to do a lot better. If you try and find that golden rule, you're actually going to confine your thinking and confine your level of taking high risk reward trades. So yeah, just understanding that Wyckoff is a mindset. It is a mindset because we're trying to follow what smart money is doing. One thing that I kind of clocked when I was learning Wyckoff theory is you think about when you first started trading, and you get told never stay away from consolidation, wait till the market's trending, only trade trending markets. That's the best way to do it. If you see a consolidation, go on to another chart. That's cool in some sense. That is cool in some sense, but that's the information that's put out there for a reason. We're purposefully told to fear consolidation, that's almost driven in us to make us feel uneasy. But if you can understand these periods of consolidation, if you can actually understand what the market is doing, the market's telling you a story. Every single thing, when the market moves, there's a purpose for it. There's a purpose for why they're distributing up here. It's because they're trying to take all the other players out of the market, all the weak people out of the market, so they can move the market down somewhere else. So understand that we're always taught, wait till the market's trending. That's perfect. But by that time, you already missed half the move. And then even when the market's trending, let's say for example, we start with accumulation down here. Let's say we start with accumulation down here, and we wait for this breakout, right? So this would be our markup when it comes to Wyckoff. And now we're waiting to get in. And what happens? There could be a reaccumulation. This reaccumulation is designed to shake people out. So it's designed to make it look like it's going to reverse, and then boom, it just continues up. So you could have waited for this breakout. Even if you're trying to get in here, there could have been no nice entry. There could have been no pullback, nothing, because what they've done is they've accumulated orders within this first period of consolidation, and they've shook everyone else out. There's no one else on the other side of the trade. They can just push. They've taken everyone's liquidity. They hit everyone's stop loss. They've flushed everyone else out of the market. They can just move the price up. But this means that it's very low resistance. This is another good way of confirming your moves. If you see a big push away and then it comes back and it tests and then it just starts to shake about a bit, it's either accumulating orders again, or likely it could turn into something else. So the point I'm trying to get across through all of this is, if you can understand the logic, understanding BC, AR, ST, that's not majorly important. I will go on to explain some of that stuff, but guys, I just want to stress how important the logic is. If I see something in the charts, I don't try and mark up every single point. Yeah, this is the BC, this is the SC, the AR. If I don't know what it is, if I can't tell for certain 100% what it is, I'm not gonna mark it up, because then you're always going to be trying to make the markets look like something. You want to respond to what the markets are showing you, not try and force the markets to be something in your head. There's main points and there's main parts of the logic which I like to define, and I'll go on to that later on. But let me just see what else I wanted to say from here. Okay, you know what? Real quick, I'll chat a little bit about the Wyckoff laws. So, I don't necessarily, trade by these laws the whole time, but I'm aware of them, and it's good to be aware of them. I'll start from the bottom going up. So, effort and result. This is very simple. It's almost like what you put in, you're going to get out, and it's the same thing in the markets. The idea is that if you have a really huge period of accumulation, so within this period, price is accumulating massively. It's accumulating, and this could be on like a 4-hour chart or something. And this is where you need to your market knowledge and your understanding. You can tell whether it's strong or not, because certain people, they learn these smart money concepts and they learn what order block is, all this kind of stuff. And even though there's huge accumulation going on, which suggests we're going to have a huge markup in price, what they'll do is they'll mark up a tiny little institutional candle here, and then all of a sudden they think that the market is just going to go like this because they marked up they source a point of interest over here, and they think there's equal lows down here, and they try and sell from here. But you have to understand that this accumulation here is for a reason. It's got a purpose. That smart money is trying to drive price higher. If they've accumulated for this whole time, if they've put in the effort to accumulate and shake out all the buyers and sellers on both sides of the market, why would the market just drop here? I see a lot of people, even myself, a mistake I made at the very start. I'd be well aware that the market's accumulating, but then because I've seen some sort of candle, all of a sudden, my bias switches. Trust me, believe in the schematic. The schematic is there for a reason. It has a purpose. It's got something behind it. It's got a motivation behind it. And another thing, this lines up with fundamentals as well. So a lot of times, let's say for example, Jerome Powell is going to come out and talk, about some sort of interest rate decision. You can actually forecast what's going to happen when that news drops. If you can understand, a schematic, you can understand the preparation. For example, I've seen examples where I've covered this, on a couple of other calls where the market's accumulated going into a news release, and then boom, you see the explosion in price at the news release, and people are catching it. And people are, how are these people catching it? It's because they understood the schematic, they understood the purpose, of the schematic. But yeah, this kind of explains effort and result. And there's certain other techniques which I don't really use. It's not something I'm comfortable with using right now. But based on the size of the schematic, based on the width of the schematic, you can forecast how great the expansion move is going to be. The other law I'll just touch on real quick is supply and demand, and this is just very simple. If you guys at economics, you'll know that if demand's going up, then price is going up. If supply is going down, price is going up. It's that kind of concept, and these are the laws that move the market. So when you see these shifts in supply and demand, or when we're looking at higher time frame points of interest, this is where all these kind of things click together. Real quick, before I show some examples, and if we have a little bit of time, I might even pass back to Kyle, because I think he might have had an example to show you. But just in case the logic wasn't making sense for some people, I'll show you guys something. If you start from a period of accumulation and you move up, right, and then we have another period of consolidation and price moves up, then we know this was reaccumulation. Reaccumulation being the fact that it was a continuation, and the same can be applied for the inverse when it comes to redistribution. But that was just something, just in case you guys were confused by that. But now I'll talk a little bit about how when I go actually to mark up something, when it comes to looking at a Wyckoff schematic, because it's very easy to see it after it's happened. Very easy. Oh yeah, that's that. There was a spring, there was a test, liquidity, all that kind of thing. But I will explain what all the elements of the schematic are. But let's say, for example, we're looking at accumulation. Pure Wyckoff and traders, they don't mark up everything. They mark up the key points and they understand key points. And that's what, trust me, if you guys focus on that, your understanding of Wyckoff will become a lot clearer, because sometimes, understand, Wyckoff's up to interpretation as well. Something might look like a UTAD or a UT and then end up being something else. So this is something that I would recommend when it comes to learning and applying Wyckoff to the charts. Wyckoff is basically establishing a trading range. So this is what, consolidation is a trading range, right? Wyckoff schematic is consolidation, and therefore when we're looking for a Wyckoff schematic, whether that accumulation, reaccumulation, redistribution, or distribution, we're looking for a trading range. What defines a trading range? Well, we're going to have an area of support and an area of resistance. So let me just get Polyline up. So let's say the market's moving down, and I'm going to mark up sort of a bit like what an accumulation schematic would start to look like. So when the market comes down, understand any sort of schematic is just a transition from X to Y, whether that be buyers to sellers, sellers to buyers, buyers to buyers, sellers to sellers, whether it be in continuation or reversal. So at the minute, the sellers are in control. The market's pushing down, sellers are in control. We have that first bounce. That first bounce is called our preliminary support. So preliminary support is the first bounce that you get. From there, we get what's called climax. So this is the thing that you need to understand. The first bounce you get, the first point in a Wyckoff schematic is going to be preliminary. That's why it's the first bit, right? Preliminary makes sense. And if we're coming from above and we're coming down, it's going to be our first sign of support. That's why it's called PS. LPS, PS is preliminary support, PSY preliminary supply. So following that, we have a climax. This is what defines the furthest point of your range. So this is what you call the climax. So for example, this would be our seller's climax. From that seller's climax, this is how I want you guys to think of it. If you was going to punch into a sponge, and that's like your last, your last burst of punching the punch bag, what's going to happen is your hand's going to fly back. That's the same kind of thing. When the sellers, they get their last push, their last climactic action, they're going to get an automatic reaction, and that's what we call the AR. And this, okay, let me just draw that back again. This climactic action, that's what defines the top of your trading range. So I'll draw this up back on again. I'll draw it in brush, that way it'll be easier. So we have our first bounce, that's our preliminary support. We have our climax, that's our seller's climax. And then we have our automatic reaction. When I see this is cool. I can now mark up my trading range, and that's what I'll do. When it comes to the chart, it can be wick to wick or bodies, whatever, but just define that trading range. When you see like an ST, all this is generally, you now want to just see, so this is the first sort of thing we see. This is the first part of our schematic. We now want to see price continue to trade within this range. We don't want it to break out, because this would imply that the consolidation isn't holding. This imply that consolidation isn't holding. So from here, we'd either see like a ST and potentially a sign of strength. All this is in general, guys, don't overcomplicate this. All this is in general is just testing that support and resistance. So this is our area of support and this is our resistance. Now, this is, I'll write something here. This is where the sellers are in control. Here, the sellers are in control. We know if we're accumulating, we have to transition to when the buyers are in control. So any schematic is just a transition. That's all it is. Transition from sellers to buyers. So in the middle here, this is where we have that transition. And then we could have something, some of the other concepts that we've learned in terms of, liquidity gets built up. And this could be your you could have multiple STs. It could be one ST. But essentially, all that's happening is liquidity is getting built up. Then, we've all seen a spring. So we could get a spring. And that's what captures this liquidity. So if you see on Go Live when Trade House, they draw this little X, it's that kind of thing. Liquidity gets built up and it gets taken. After this liquidity gets taken, what they've done is here, this is what Kyle was speaking about and what Ashwin and Issam were speaking about yesterday, is that they've removed everyone else from the market. They've hit their stops, whether that be their stop loss or their sell stop orders. They've been triggered, and now there's no resistance in the move up. They've manipulated here. This would be our spring. I know this gets really messy, guys. I'm going to go into some chart examples as well in a second, but I wanted to just explain the logic in terms of how we define the trading range. So this would be our spring. We come back down to test this, and then we push away. So I know this might be kind of confusing. The chart looks kind of messy and stuff, but I'm going to show you guys some actual examples. And then, yeah, after that, I might pass back to Kyle and he'll go over a few things. What's messages? Okay, sick. So this is something that probably looks real complicated, but this is a reaccumulation, and within it we have a minor accumulation. You know, here I haven't marked up everything. This is what I wanted to point out to you guys, but within this, what I did when I started was I defined my trading range. So I've got my climax and my automatic reaction. This defines the trading range. So now I know that I want something to happen in this trading range. It's either going to be, okay, cool, I see some sort of movement and I get a distribution, or it's going to be reaccumulation. So this is what defined my trading range, the AR and the BC. Within this, we actually emerged and had another trading range. So I drew that up, and I didn't try and mark up BC, AR, you know, every single little thing here, but where I've drawn these little waves, this is just to show the logic of things that are happening. There's no real clear direction. Everything is staying within this range. It's only here when we break out, we have that first sign of strength. We come back down, we push away, we built up liquidity here, we took that liquidity, and even within here, I don't know if you guys can see this. I don't know if it's going to let me zoom in.
Your screen, we can only see your trading view is still open.
Okay. Yeah, let me just like edit the share real quick. New share. All right, sick. You guys can see now, yeah?
Perfect.
Okay, sick. Guys, okay, I'm gonna show you some examples real quick. Just going over this one. This is a reaccumulation. So this big box here is a reaccumulation. Within this, there's a minor accumulation. This is what this small little box is here. What I was explaining before is when I define my trading range, that's the first thing I try and do. So the buyer's climax and my automatic reaction, that defines my trading range. And then from there, I even, you know, now I know I'm gonna have some sort of period of consolidation. I know it's either gonna be a distribution, we're gonna get a reversal, or we're gonna get continuation, and we're gonna get reaccumulation. I understand that, you know, majority of the times you should be biased towards a continuation, just by, you know, the fact of probability that, you know, more times than reversal happening, you're going to get continuation. So this is how I define my range to start with: the buyer's climax, the automatic reaction. You know, this isn't, you know, majorly important right now, but just in terms of defining the trading range, these two lines here, hopefully you guys can understand that. That was what defined my trading range. Within that, we had a smaller trading range. You see how, you know, price was, you know, very respecting. This is kind of like a retail concept, you know, in terms of support and resistance. You know, what was happening here was just, you know, buyers and sellers on both sides are just getting shaken out. There was no real direction, and there was not, you know, just like sloppy kind of price action. Only here was the first sign of strength where we broke out of this small trading range. We pushed down, built up liquidity. We sprung that liquidity. I'll just zoom in so you guys can see that. Here's that liquidity that built up. It got taken. It pushed away. And this is again in here, you know, above this candle, this red box would have been my point of interest on a smaller time frame. We had a smaller accumulation, and then that sprung within this point of interest and pushed away. So this is a little bit touching on what Kyle was saying in terms of how everything fits together. So I hope this kind of makes sense. This is more of a complex example, but the idea is that I'm just trying to show you guys that I didn't try and mark up every little component. If I tried to mark up, you know, what this little bump is, what all these kind of things are, you know, Wyckoff's not picture perfect, trading's not picture perfect. The idea is I was in the understanding that something's going on here. They're shaking people out of the market, and until I got something clear over here, I wasn't looking to enter. So here's another little example where the same kind of thing is that I've got a phase of distribution up here. I've declined. This to me, you know, now looks like it's reaccumulating to potentially push higher, but then this failed. This pushed down. We came and filled in this order block down here. We took out some liquidity. Then we had another, you know, accumulation looking structure here, and we pushed up. So this is again just to show you that not everything's going to be like picture perfect, but the logic is always there. You're seeing these, you know, everything fits together kind of thing. You know, everything has a purpose. You know, that their idea was in this whole box. You know, smart money wanted to shake everyone out. We wanted to shake everyone out, put no one else on the other side of the trade. If you tried to trade this, you guys would get confused. And that's the whole point of it. The whole point of it is to get you guys out of the market so they can just shoot the market out with no resistance. I'll show you guys a couple more examples, and then if Kyle wants to go over another one, then he can go over that. I think he did show this one. This is a reaccumulation. The reaccumulation, again, you know, look, the buyer's climax and the AR, this is our climax and our reaction that define the trading range. We had our ST, and here, these 2 points here, they're just testing those zones, the support and resistance zones that we had before. Then we had our liquidity built up. That's a simple concept that we got taught by Ihsan Ashwin. We had a spring to take out that liquidity. Now we're waiting for a test of that spring. When it came to that test of that spring, we built up liquidity and we accumulated above that test, above that, you know, area in which we wanted to get that test. So this is how, you know, everything is fractal. Within this reaccumulation, we've got a smaller accumulation. So this is, you know, just about getting more accuracy. Another one here, like, you know, we've gone over loads of accumulation. This is a clean distribution. Same thing. I like to define the trading range, BC, the AR. You know, it's not an exact science, but I just like to have a clear trading range in my head, because then I know I don't have to rush into any trade until I see a progression of this channel, of this trading range. And this, you know, obviously other people throughout the week are going to touch on entries and stuff like that, but just to touch a little bit on how the majority of the time entries are taken, we like to wait until we've had a UTAD or a spring, depending on the type of schematic, and we like to enter on tests and LPS or LPSY. So depending on the schematic, this is where we want to get in. These points here is where we want to get in, because it's only at these points that we know what the market is going to do now. We know that the way the market is going to be directed, you know, what way the market wants to move based on what smart money has manipulated and the way they've shaken out everyone else. See if there's another kind of nice example. Okay, cool. Yeah, this is another example. You guys can like screenshot this or something if you guys want to screenshot. I hope it's not too zoomed out or nothing. But yeah, again, you know, this is not necessarily a textbook example of a schematic, because it's just about understanding. You know, the main ideas is behind the climax, the reaction, having liquidity get built up. We may have tests of both the support and the resistance, and then the liquidity can get taken. And then it's about, you know, something that is a bit more advanced. I might get covered on later on in the boot camp in terms of order flow and the way in which price is just stepping itself up. An important thing, this is probably the last thing I'm going to end on, just because I don't want to take up too much time. I know it's late, but something to understand is that, if this is kind of advanced for you guys, but when you have an accumulation, you want to see this structure being very clearly maintained. That's what makes this such a low resistance move. Look, you see how this is our last low. This is a previous low after that. Then we had a, you know, straight away, this is perfect trending structure. No structure is getting broken at all. They're just stepping price up. They're just, you know, finessing liquidity, pushing away and testing it. And again, you know, by the time we get to the end of this trading range, look at it just explode. Look at it just explode. And then it's probably kind of hard to even get entry after this. But that's just something in terms of the move being so low resistance. And that's all because of this. That's all because in this trading range, they finesse everyone. They got all the weak people out of the trading. You know, they got everyone out of their trades, and by the time they realize the market's going to go up, it's too late. You know, the move just flies up. I think I might actually have one more example on gold, which I may share. Okay, sick. Yeah, this is the last example on gold. This, you know, I had a point of interest. This is what this imbalance feel. This was a point of interest, and I had a spring into this point of interest. This is something that we will get to later on, but it's just kind of a nice example of accumulation. This is kind of early on when I started using Wyckoff, but again, I had my trading range, my climax and my AR, and then we pushed down. This is what this candle here does. It finesses, you know, the first part of liquidity. Then we get more liquidity built up with this ST. It gets taken, and then we get multiple tests, and, you know, the LPS, which allows for the market to then move up. But yeah, guys, I won't take any more time. I know that that's been, you know, covered a lot of content. Oh, my screen sharing is paused. Okay, man, this is my screen sharing is paused. I don't know why it's Okay, yeah. Never mind. It says it's paused, but yeah, guys. Wait, Kyle, bro, do you wanna go over another example, or
No, it's all good. I wanna respect everyone's time. I was just thinking if anyone had questions, then we could do like a, I don't know, 5-minute Q&A, but I know I'm good. You've literally...
Yeah, we can do questions if you guys want. We'll do questions until 1:45, and then yeah, if you guys want to do questions until 1:45, then we can cover that stuff. Let me stop this share. Wait, Mohammed, do you wanna like make the chat so like everyone then they can ask questions? Can you explain fractals more? Kyle, bro, do you wanna go over fractals or?
I don't explain it in what's it called? You explain it in different words because maybe the way I explained it, like through my words, people didn't understand.
I mean, fractals generally just means that, let's say for example, something's accumulating on a higher time frame. If you zoomed in, you know, for example, you could have a test within a certain point in your accumulation. Let's say you had a test, right? Within that test, there could actually be a smaller trading range on a lower time frame. And if you even when within that, there could be another trading range within that. There could be another schematic going on within that. So it's almost like Inception. You know, you've got schematics inside of schematics kind of thing. That's the fractals just means that stuff can keep getting broken down to like the finest point because it's so continuous. And the fact that you can see all these patterns will just be within patterns and stuff like that. But in terms of how we use fractals, is just the fractal nature of the market means that we can see schematics within schematics. But yeah, I hope that answers whoever's question that was.
I don't know what is volume related means. How do you?
Volume is kind of related, yeah.
Oh, right, okay. How do you use imbalance with Wyckoff? I can't lie, a lot of the entries will be gone over tomorrow, but imbalance is pretty much just an type of entry that you can use within Wyckoff, i.e. if you have some sort of imbalance that is formed after a spring, then the test might come into the imbalance. How to stop confusing UT with UTAD. Something I kind of mentioned there is that a UTAD is kind of like an injection in price. It's quite quick, like that. I'm not saying it's every time, but I'm not gonna lie, like a very large amount of the time, like UTAD spring, it'll be quick. Like it's a nice little injection.
Another thing is that with UTAD, if you have a UTAD, because that's such a high volume, not high volume, but as in like, because it's such a big injection into the market, what Kyle was saying is that it's usually followed right by a test. That's how you can sort of differentiate between, UT and UTAD, is that if you get an immediate test, it's likely to be the first schematic where you have a spring. Wait, how do you spot a Wyckoff while it's occurring before the spring? Guys, this is what I would say, define the trading range. That's the first thing to do. Define the trading range, and Wyckoff, has to be partnered with other things. Has to be partnered with smart money concepts or even like retail trading, because you need to have an idea of where you want the accumulation or distribution to occur. If you can predict the spring, that's because you need to have some sort of point of interest. You need to have some sort of point of interest in mind, but that will get covered later on in the bootcamp kind of thing. It's a very in-depth thing. We just like to give people the logic. What further source of learning would you recommend? I think Mohammed put Bullish Rev in the chat, so I recommend that. But yeah, Kyle, you can do something else.
What time frame do you sell? Yeah, so we don't really use support and resistance, right? We use smart money concepts. A pure Wyckoff trader does use support and resistance, but the point is that we say like Wyckoff plus like smart money together is a very nice combination, because you can, instead of looking for let's say support, for example, of the, if I'm getting it right, like the AR or the selling climax, for example, sorry, the same climax. If you look, like, for example, if you look for support of like same climax or resistance of the UT, we don't really do that. We're all looking for entries off institutional candles, imbalance fills, all that kind of stuff. As a beginner, do I just search these schematics? Yes. So I would suggest you print them off. That's a good thing. Like if you want to see it on a regular, defo, go and print it off. On what time? Who do you watch on Go Live? Any Trade House educators, i.e. Zachary and Jordan, any of the steady guys. But one thing I do like to mention that I think a lot of people don't go over is that look for the students within Zachary and Jordan and who else is it? And okay, they go on Rock's channel quite a lot, or even any of the, basically you want to look for the students of the Trade House educators, so people like Viva Valentino, Siva, Trade with Matthew. Where did you learn React Redistro? I'm pretty sure Wally posted it in one of our, well, this is for me personally. I'm pretty sure he posted it in bank discussion, and we had a look. He did a little training for us on one of our AM sessions, and then from there I just had a look myself really. Do you always wait for break structure or to for test to take place? So this one is quite a difficult one because the thing is you don't, right? But for someone who isn't experienced in Wyckoff, I wouldn't expect you to know that that's going to happen, if that makes sense. Like, if I don't know where you are in terms of your trading journey, but let's say you're someone who's just starting off Wyckoff, you're not going to be able to notice it without a breaking structure. But a lot of the time that will leave you missing the trade. But once you get a bit better, you'll be able to do that. Maka, you can take a few if you want.
Yeah. So it says like, what is your way of backtesting? To be honest, I just like to look for backtesting is like something where you want to look. Backtesting is good, yeah, just to understand something. Obviously, let's say for example you backtest 10 times. That's not going to help you see it in real life 10 times. It's going to make you see it in real life like once or twice. So the way of backtesting, you want to, in terms of spotting schematics, you just want to go to, we'll no more questions after these ones. But yeah, I'll go to, for example, 4-hour chart or something. And if I see a big reversal, I'll zoom in right to the top or the bottom of the reversal, and I'll zoom in and see if I can find a distribution or accumulation on like a couple time frames below, and then zoom in and try and see if I can figure out what the entry was taken off, trying to find a trading range, try and mark it up, kind of thing. In terms of the most important areas to look for in the schematics, like I said, you define the trading range is the most important thing in my opinion. The BC and the AR, they're probably the most important things. A creek is important as well because it tells you the character. It tells you the character of the schematic. Also, maybe like a sign of strength or sign of weakness. This is just showing you, more like of a directional purpose of the schematic. I don't know if you want to add anything, Carl, bro.
No, that's all good.
So if that was all the questions, I just want to say, well done for everyone's hopping on. I know we had a lot of people hop on at the start kind of thing. It was kind of late. We had a lot of other calls going on during the day, but well done for you guys for hopping on. I know it's kind of late for everyone. Everyone wants to get out, trade London session or whatever. But yeah, guys, thank you very much for having us on the call. Super excited for the rest of the boot camp. It's going to be sick, man. I'm probably excited, especially, the rest of the week. We've got special guests as well. Make sure, pack out every single one of these calls for the rest of the week. But yeah, guys, okay, guys, any other questions, just drop me or Kyle a DM or something. Or get our numbers or something or someone. But yeah, guys, I'm gonna let you guys hop off and go sleep. I know you guys want to get up early and stuff, but that's all I had to say, guys. But thank you very much for having us on, and yeah, I'll leave you guys to it.